Hey folks, Dan Frio here with your closing bell for September 27th, 2024. So mortgage rates, here they are. Once these update, they'll be down just a little bit. You might see the 30-year fix down in 6.1 something. How do I know that? Well, if you go to the bond market right here, it's doing pretty well. It's up 15 ticks. That means mortgage rates are coming down. So what's happening today? Well, the PCE, the number one inflation gauge that the Federal Reserve monitors, it came in today and came in a little bit cooler than expected. The overall equity markets are liking it. The Dow Jones is up over 200 points. The S&P 500 and NASDAQ, they're down just a tad. Russell 2000 is up. VIX is up a tad, but nothing to worry about there. Cryptocurrency is on a tear once again, and we have oil just still staying below $70 a barrel, so we're okay there on the inflation front. So let's see what's actually happened today. Let's get an interview from CNBC. They can kind of wrap some of this up for us, and then we come back. I'm going to talk about home prices, the PCE shelter number, how we know inflation's coming down just based on that number alone, and then we're going to talk about FHA foreclosures. Spiking? Are they? So let's get to the interview.
Begin with the Fed's preferred inflation gauge, the August PCE, coming in cooler than expected, climbing just 0.1%, puts the 12-month inflation rate at 2.2, and that's the lowest reading since Feb of 21. The core still running hotter, 2.7, but those numbers are not changing my next guess base case of quarter-point cuts for the rest of the year. It's not priced in right now, by the way, but she also says the bar isn't particularly high for bigger ones. Joining us now is Julia Coronado, founder of Macro Policy Perspectives, and CNBC's own senior economics reporter, Steve Leisman. Steve, will you just set the stage for us briefly? What is the market's current anticipation, or what is priced in for rate cuts?
Okay, some fresh quotes right here. Surprising to me, by the way, Kelly, I thought you might get a little more movement, but it's 54% for a 50 and 46% for a 25. So leaning a little bit more towards a 50. You were at 51 going into the meeting. Now remember, it's been as high as 65%.
They're talking about the CME FedWatch tool. If you kind of got lost on what he's talking about, where the numbers are expected to be.
But we got some better than expected data. You also had these revisions to income and spending that are generally higher over the past several months and several years. So all of that, and by the way, also an upward revision, as we talked about yesterday, to the savings rate, all of that helping to suggest that maybe the economy is a touch stronger than previously believed. Maybe the weakness that we might get is from a somewhat higher level. So not a big move by the market when it comes to the outlook for the Fed here. Just a 54% chance of a 50.
To that point, though, as the data has been incredibly resilient, Nancy Lazar just upped her fourth quarter GDP estimate from, I think it was a -1 or a -2 to a positive. So I think, I don't want to say people are throwing in the towel, Julia, but this confounds what many of the bears, I mean, if we really go through this quarter, and it's obvious this quarter, next quarter, it's not going to be a negative. I mean, we really are talking about the recession never showed up. At least if it shows up at this point, it's so far delayed as to almost apply to a different business cycle.
Yeah, no, it's been a good run for those of us in the soft landing camp. And luckily, I think what we're seeing is the stars aligning. Yes, the economy is resilient. But the labor market is cooling, and inflation looks what Chair Powell referred to as a few basis points from target. So they've seen enough, they can recalibrate, and that's going to provide relief to a lot of the interest-sensitive sectors and give us a little bit. What worries me in the labor market is we didn't really have an engine of growth. No, there's not mass layoffs, but there's more caution on hiring. It's spreading across sectors and industries. And what we need is some industries to turn around and start deciding that it's time to add workers again to keep that feedback loop between hiring and spending on track. I think we've got a very good shot at it. It remains our base case. I think the speed of the rate cuts matters less. It's more that the Fed has told us that they're going to do what it takes to achieve the soft landing. And so, I think that they've built a lot of credibility fighting inflation. Now, they need to show us, put their money where their mouth is and keep the economy on track.
And what I want to dwell on with you, Julia, is this issue that more and more people are asking about inflation and whether it actually could start to look sticky again. I just wanted to mention, to your point about we need an engine of hiring, Great article by my former colleague Ruth Simon in the Wall Street Journal yesterday. I mean, the lead tells that a tire seller will open more stores. A maker of gun safes plans to boost advertising. A candle maker is looking to take out a $20,000 loan to expand for the holidays. Small businesses were hurt the most by rate hikes, and they're immediately feeling the kind of relief that will, at the margin, perhaps help on hiring and spending and so forth.
Absolutely. And I was just talking to a multifamily developer who was saying the same thing, that they're seeing the light at the end of the tunnel. They've been dealing with the oversupply, but they think that they'll be building full speed in the next 12 to 18 months. And that's great news for inflation. The stickiest part of inflation has been housing inflation. That's where we're getting to this danger zone where rate hikes are going to choke off supply. Now that we can release some of that pressure, hopefully we'll build a pipeline of supply that will keep that inflation in check and this isn't just about the next few months, over the next year or two is really what we're talking about now.
We're going to exactly.
Okay, we'll keep it at that. So here's what a lot of people don't, maybe this is just something to throw out there for the the employee numbers. AI can take a lot of jobs. We also know there's a lot of non-documented immigration coming in. I don't think everybody's just sitting at a corner. I bet you a lot of those people are working as well, and maybe we don't know about it. So just a food for thought on the employment numbers. Okay, so let's get over to the housing market. It's starting to cool down, folks. We see right through here, house prices continue to cool in August, up 3% year over year. Several cities in Florida are now seeing year over year price declines. Yes, price declines. And then, but still, the overall, they're up 3%. And then over on the PCE, this is the inflation number that the Federal Reserve puts the most weight on. And they just said the shelter number is one of the ones that's skewing this number. And even Federal Chairman Powell said it. Janet Yellen said it. They both said these numbers are coming down. They're lagging. These numbers are coming down. And when they do, inflation's going to drop even more. That is reiterated right through here. It says, since asking rents are mostly flat year over year, these measures will slowly contribute to a decline over the next years. So that's what we're seeing right through there. And now one thing that I want to address, you're going to start seeing video after video after video of FHA loans are in foreclosure and they're going to bubble. And they're also, because why? Well, Nick just posted a video recently saying FHA delinquency is skyrocketing. So I just did FHA delinquency, and here's all the stuff that comes up. You have this one, FHA delinquencies worse than 2013. Well, this is 1 year ago, and it hasn't happened. This one, Nick, HUD, 100% surge in 90-day delinquencies. That's 4 months ago, and I'm going to show you all this data right at hand. Then you go down through here, one rental at a time. This is pretty. They're pretty good. This lady over here, she is on the side of the bandwagon with the rest of these guys through here. So it's always bad news. Then we'll just scroll down a little bit more right through here. Housing bubble delinquencies rising crazy, and that's 3 years ago. So they've been telling us this since 2020, maybe. Well, let's get over to the facts. Here's the facts. This is FHA, the housing numbers from Statistica, and this is just out. Nick came out. Nick, he's at Reventure. He's Nick. He's the grand poobah of the Crashing Brothers, and this is what everybody aspires to be. Nick. Okay, so let's get over to. He just said FHA delinquencies are at 10%. I think he might have said it's never been that high or whatever. Well, let's check and see if that is accurate. So the 10% figure he has is based in this element. Okay, so you got 10.6% in Q2 of 2024. Okay, so let's go back. In Q4 of 2023, it was 10. In Q4 of 2022, it was 10. In Q4 of 2021, it was 10. In whatever 1, 2, 3, or 4 in 2020, it was over. Back in, so it's not like this is an anomaly. Okay, let's get to some other information. This is from HUD, or this is from FHA. Here it is, FHA single-family performance trends. Okay, you go down through here, and all I'm going to show you right here, I'm not going to dwell on this, but be careful in what you watch, folks. Okay, delinquency rates by month. Okay, 30-day late, 60, 90-day late. Let's go down through here. So in August, there were 7.4 million people at a 5.5 rate. You go down through here, and it ticks up and ticks down and ticks up and ticks down. Now we're at 6.1. Is it a huge move, 100% move? No. Okay, same thing with over through in this column. Now this is seasonally adjusted, same thing. Right now at 5.9, was 6.3, was it 6.4, was it 6, was it 5.9? So it's not there, it's just another thing to get you to click. Okay, and last but not least, this is from FHA, and this was just posted this week. FHA. Okay, you go down through here, and here's the data, folks. Initial forbearances plans decreased to 20,500 in the second quarter from 21,000. You go down through here. The 60-day delinquency rate remains unchanged at 0.7. The 90 days are unchanged, and foreclosures fell 7%. Okay, I'll just stop at that. So please do yourself a courtesy. Pay attention to what you're watching. If you want to watch stuff for entertainment purposes, these guys are probably perfect. If you really want to know the facts, you're going to have to go somewhere else. So that's that part of the equation. Just wanted to prep you guys for all these FHA delinquency videos coming out. Okay. Let's look at our portfolio, folks, and then we're going to leave it for the weekend. So what I've been doing is showing you a portfolio basket of stuff, and we're going to be adding to this. I know we haven't added in the last 2 weeks, but we will be adding something to this every month, and we're going to do our due diligence on it. We'll do that the first week of each month. We're going to go through and pick something. I'm going to show you how to look at its PE ratios, dividend yields, its expense ratios, and so forth, so you understand it. But right through here are the top 4 picks that we've had this month, and we just started this. Basically what I did is went out there and picked some ETFs, some investments that you guys can do some research in, okay? And what I picked is XLF, which is an ETF, a basket of stocks in the financial markets. We got Berkshire Hathaway. We got Bitcoin on steroids. This is Bitcoin times 2. So it double amplifies if it goes up or down. So be careful in this one if you get in this. I'm not suggesting you guys get invested in this one. And then the SPDR. This is the top 500 companies in the country. By buying one share of that, you're getting all these companies. This is the returns that we've had over the last 2 weeks. So this is how you can understand how the haves have more, because the markets hit a basically a record high every day. That's not going to continue forever. So the goal here is, I'm not saying this in hopefully there's a correction so you guys can see over the next year or so how by dollar cost averaging, you can kind of take those huge bumps out of the way. So I invest in the long term just the same way I buy my homes. I invest in my home that I'm going to stay in for 5-10 years possibly. If you're just looking to put money into something and make a good return, you might want to look at stocks versus real estate. So that's my report for today. Okay, so who am I? How can I help you? Well, I'm actually a mortgage loan officer at ServBank. ServBank is the number 10 mortgage servicer in the entire country. We're also one of the largest mortgage brokerages. So by using us, we're going to basically take the heavy work out of your life when it comes to a mortgage. You go out there and try to find that house, or you send in your mortgage statements to let us see if we can save you some money on a refinance. So what do you need to do? Well, go to the rate update. You're going to find all you need to know about me. But if you're buying that first house, what I want you to do is check out the Grant Finder right through there. It might help you with your down payments or maybe your closing costs. So that's my report for today, folks. I hope you had a great weekend, or I hope you have a great weekend, and I will see you back here on Monday, God willing. So God bless. Have a fantastic weekend. See you here on Monday. Bye-bye.